Live from Bloomberg's World Headquarters in New York, I'm Scarlett Fu.
And I'm Joe Weisenthal. We're 30 minutes from the close of trading here in the U.S.
Breaking news, the House has enough votes to adopt the budget resolution. In fact, they have just finished voting, and these are House leaders who are approving a measure to enable a swift repeal of Obamacare. This is a budget resolution, and that element is folded into the budget resolution, the element to repeal Obamacare. And of course, this had already passed the Senate, and we will see how this proceeds. But this was the first of many steps taken to repeal President Obama's legislative landmark deal on health care.
The question is, what'd you miss?
The outlook for top U.S. banks is brightening, especially at J.P. Morgan, which reported a jump in fourth quarter profit and a record year for earnings. But one bank risks falling behind in an era of rising interest rates. Wells Fargo posting a profit decline. We'll hear what the CFO has to say. John Shrewsbury joins us right around the close. Plus, President-elect Donald Trump takes the seat in the White House next week. Could one of his first orders of business be to address M&A? We'll hear from the major deal maker, Centerview Partner co-founder Blair Efron.
Meanwhile, the House continues to vote. Obviously, this is not the final step. There is several things have to happen. And, of course, there's a lot of controversy about the timing because Republicans don't necessarily want to be in a position where they've repealed it but don't have anything to replace it. Let's now go to Bloomberg News reporter Kevin Cirilli. He's on Capitol Hill monitoring this vote. Kevin, what happened? What is the significance of this vote and what happens now?
This paves the way for Republicans to take additional steps in order to continue to repeal Obamacare. They cleared a procedural hurdle similar to what the Senate did earlier this week. Now, this is where it gets interesting. There's disagreement amongst Republicans about the timeline and just how to offer an Obamacare alternative.
Right, and the big issue is some Republicans feel there should be a replacement already in place before they go ahead and repeal. So how does that play into what happens next?
You know, I talked to some Republicans here up on the Hill, like Senator Rand Paul, who argue that there should be a full repeal with an immediate full replacement. But then I talked to other Republicans up here, such as the vice chairman of the House Republican Conference, Representative Doug Collins, who argue that there should be a full repeal, but wait a little bit and implement portions of an alternative. Because, look, you look at polling amongst Republicans and amongst all Americans, Obamacare is largely unpopular, but there are key parts of Obamacare that remain popular, and Republican leadership is concerned that if they were to offer an immediate repeal and an immediate replacement, that they would be proving political poison for some of their Republican colleagues who are up for re-election in 2018. So a lot of finessing going on behind the scenes. And then, of course, you have a new administration taking office in a week.
Right. As you said, Obamacare is unpopular, but a lot of the elements of Obamacare, such as the fact that insurance companies can't deny you for having a pre-existing condition and so forth, are popular. And so what does a health care replacement look like that keeps the popular portions of Obamacare, but that's not Obamacare?
You know, I've been asking some House Republican aides this very question, and I can tell you that they seemingly are going to be looking at things like health savings accounts, for example, and they're also relying heavily on the incoming administration. And the Trump transition team has yet to put out their own timeline for when they would like to see to implement their own plans. But that said, you could see on January 20th political optics being used to portray and put forth a message that this is a president who wants to fulfill his campaign promises, but also, again, jockey to protect the political majority for 2018. Either way, a lot of moving parts here on Capitol Hill. I can tell you that House Speaker Paul Ryan is working closely with the incoming administration to get on the same page. Press Secretary for the Trump transition team, Sean Spicer, is adamant that they are all speaking from the same political playbook, but a lot of questions remain about the divisions within the Republican Party and what exactly they will do. Representative Collins told me that he would anticipate the next step on an Obamacare alternative to happen mid-February.
Okay, mid-February. We'll look for that. In the meantime, this vote to repeal Obamacare is embedded in this budget vote. What else is part of this budget vote? Maybe we should know the details there.
Well, when you take a broader step back at what this budget is going to do, is it's funding things like military. It's funding things like military spending and as well as a host of other economic portions. And again, just to quickly talk again about Obamacare and the popular parts of this bill, I hear we have a soundbite ready for Representative Collins. Let's take a listen to what he had to say earlier.
You're right. Donald Trump won because he made an appeal to the American people about a bad law. And you do have parts of it that people like. He actually said that. We've actually talked about the 26 staying on your insurance, pre-existing conditions being taken care of. Those are things that will be taken care of. And Republicans, even 6 years ago, never had a problem with that. Here's the problem we had, is things that could have been fixed then with a simpler, more holistic, more patient-centered, doctor-centered approach to where everybody could have access to affordable care. They chose to overhaul it with a government health care system. What we're going back to now is making sure that some of those things that could have been done easily then are now put in place where people can have, every American have access to affordable care, that pre-existing conditions are covered, and those things are taken care of. And I think the president tapped into that. That's what we're looking for. That's why we're going at this approach, taking it very methodically, doing exactly what we told the American people we would do. We would repeal this law, and we would put in a patient-centered, doctor-centered approach that is much more of a 21st century health care than what we have now.
So you're hearing again Republicans who fought hard to repeal Obamacare during the campaign season now transition into a period of governance.
All right, Bloomberg's Kevin Cirilli joining us from Capitol Hill. Thank you so much. They have a tough road ahead. Coming up on What You Missed, we'll hear from one of Wall Street's biggest deal makers, Blair Efron, as Centerview partners on M&A under a Trump administration. This is Bloomberg.
What you miss? A new study by Harvard's Joint Center for Housing Studies shows that the U.S. will add 25 million households by 2035. And while that's an increase from the last decade, it's nothing compared to the 70s. Here to explain what's happening is Daniel McHugh, a senior research associate who wrote the study. He joins us from Cambridge. Daniel, thank you very much. So one of the cases that people make to be optimistic about the economy is that there's just lots of demand still coming due to household formation. That's going to need a lot of new houses. How strong is the tailwind going to be for the household sector, for homes, from just raw household formation, all these millions of new households?
Our study suggests that it is a strong tailwind. We looked at kind of the big picture in terms of what the demographics and population growth and change are expecting, leading us to expect for the number of households, and it expects a pickup. Especially relative to the last decade, where the recession, really kind of took a hit to household growth.
Right, and we kind of saw household growth, formation growth taper off and plateau. Are we back on the trajectory that we're on before?
We are. I think, household growth, we're expecting household growth to be in the 1.3 to 1.4 million range per year, which, as I said, is up from the 600,000. So it's more than twice what we saw in a few years over the past 10 years. But it's about what we saw in the 1990s, not exactly what we saw in the 70s, as you said, when the baby boom was kind of entering the age of household formation. But it is kind of suggestive of, underlying, significantly positive underlying demographics behind the future for housing demand.
Do you believe
and that the demand is really going to be characterized by growth in a lot of senior households, a lot of millennials forming new households, and really a growing number of minority households, which will kind of reshape the kind of distribution of demand and the types of housing that's needed.
Yeah, I just want to ask about that. First of all, do you believe that we're currently adding to the existing housing stock fast enough to absorb all this demand, or are we going to have to kick it up a notch? And second of all, what is the nature of the homes that will be in demand? Of course, we've seen multifamily do very well for a long time, single family not as well. How much more are we going to need, and what do you expect the breakdown will be in different kinds of household home types?
Well, to hit your second question first, the home types will really be driven from what we see by, significant growth in senior households will mean a big growth in single-person households, in demand for less, consumption of smaller housing units. I think the rise of the millennials and the aging of this large generation from their 20s into their 30s will really impact larger single-family homes more than it had, and more than was demanded in the past decade. So we call for a growth in the number of married couple households, which suggests additional need for space, which is better obtained through, or more likely obtained through single-family housing. So so over the next 10 years, the growth in the demand for single-family housing will follow the aging of the millennials, in my opinion.
For senior households, I noticed that you broke it down in terms of ethnicity. There was whites versus Hispanics, Asians, and blacks. I wonder what kind of residential construction will be needed, given that there tends to be a lot of multi-generational households among Asian and Hispanic families.
Definitely, and I think the increasing diversity of housing demand will mean an increasing need for diversity in the housing stock. So whether it's increased construction to accommodate different housing types that allow for multi-generational living, or more adult children living with their parents, in sort of separate compartments, whether that's a new house or whether that is adjusting the housing stock of current parents or current owners, that are getting older and able to use their housing in different ways.
We're seeing some just sort of other changes in demographics. People are getting married later in life, having kids later in life. We're also seeing more senior couples where both spouses are alive just because people are living longer. How do these things affect the aggregate expectations, the headline numbers?
Well, I think seniors increases in health and longevity, and being healthy for later in life has translated into people able to maintain living in their home for longer, and has reduced or delayed, I guess, the demand for living in senior nursing home type of situations. But it's also kind of increased the number of older adults living alone, increased the need for to adjust the housing stock to accommodate a growing older population. Part of these projections shows that the number of householders 80 years old or over is set to double in the next in the next 10 or next 20 years. And also another fact being that in 2035 we really expect 1 in 3 households is going to be over the age of 65. So that really, given the associated growing needs for accessibility and the increasing likelihood of having some sort of disability, I think that's really going to call for an increased need to kind of adjust the housing stock to fit this rising unprecedented growth in the number of older households.
All right, great report. Thank you very much for coming on. Daniel McHugh, Harvard Joint Center for Housing Studies Senior Research Associate.
What'd you miss? Centerview Partners founder Blair Efron is one of the biggest deal makers on Wall Street. He has advised on transactions including P&G's $57 billion purchase of Gillette and Nabisco's sale to Kraft for $19 billion. Earlier today, Bloomberg's Eric Schatzker asked him how Donald Trump's potential policies could affect M&A and what corporate America's mood is around the president-elect.
Let's put the Trump piece aside for the second. So how does the CEO typically, what is his mood today? I would say that his or her mood today is as optimistic for January as I have seen it over several years. If you look at some of the commentary you've seen from CEOs, Jeff Immelt to General Electric, they've talked in incredibly optimistic ways. Typically this time of year, IMF, CBO, they've come out with estimates. IMF, I think, is 2.3, 2.4% growth in the U.S., 3.5% globally. I think for the first time, you talk to a CEO, he or she will say there's an opportunity to beat that. Good environment on markets, labor, good, wages rising, retail good, investment good, and obviously optimism is a great stimulus.
So now, what are you telling them to do? Yes.
So clearly there is a level of uncertainty which comes from waiting to see what the data points are. It's easy to say tax reform, a good thing. It's easy to say infrastructure, a good thing, regulatory reform. The fact is, we don't know what it really is going to look like. We don't know what Congress will say it ought to look like, and we don't know the timetable. So I think for the most part, M&A, when it comes to cross-border or things transformational, needs to get these data points before we go on the next leg.
If things play out the way they're expected to, well, there's a range of expectations, but there's a direction. What kinds of deals become more attractive? What kinds of deals become less attractive or perhaps less doable?
Great question. So first of all, the deal environment typically is driven by 2 facts right now that is much more general. One, every sector is undergoing rapid change on a global basis, whether it's technology, competitive threats. That is the biggest factor driving M&A. Combined with, if you think you have a stable global economic backdrop, you can be comfortable and more comfortable that the first 12, 18 months post closing your transaction, you have a stable runway. So within that context, that's the biggest factor. Now, if I look at on a Trump basis, obviously it's cross-border. Obviously it's consolidation. What will the regulatory regime say from an antitrust perspective on continued consolidation? These are the big data points.
What's your expectation? My
expectation is that it'll be lumpy, and it'll be not necessarily a policy which at least through 2017, you can say there's enough data points that you know how it'll play out. So every situation will have to be examined very carefully on its merits.
So do I interpret lumpy as inconsistent?
We need to know more. Yeah, I think inconsistent, maybe your word. I look at it as you need a body of deals to go through the pipeline to figure out where we really stand.
Will the president-elect, once he's in office, bully companies into doing different kinds of deals, the way that he has already started with offshoring and trade, for example?
I think it's very difficult for anybody outside of any company to bully a company into doing something. Yes, you saw it with the financial crisis in 2008, highly unusual. We still talk about it almost 10 years later. Companies will do...
What about what we've just seen with Ford and Toyota, for example?
Those are different deals. That's not M&A. So I accept that you'll see a lot of that. And by the way, symbols matter. What you say, language matters. So the idea that you start to do a few of those data points, in some ways, starts to become self-enforcing for companies.
So it's difficult to bully companies on deals. Why? Because
you're spending shareholder capital, and you want to do something that is smart strategically for the long term and makes sense financially for the shorter term.
That was Centerview Partners co-founder Blair Efron speaking with Eric Schatzker. Coming up next, U.S. stocks advancing as banks rallied following fourth quarter results from J.P. Morgan, Bank of America, and Wells Fargo. At 4 p.m., Wells Fargo CFO John Shrewsbury will be joining us from San Francisco to break down their results and give us his take for the quarters ahead. This is Bloomberg. I'm Scarlett Fu. What'd you miss? Well, the big banks reported earnings, so I wanted to take a look at the return on equity, ROE, for J.P. Morgan. And this really tells a story since the I want to say collapse, but it's clearly not. The financial crisis.
Collapse, basically.
Financial crisis.
Fair.
How about that? All right. In 2007, J.P. Morgan's ROE was almost 13%. And then, of course, it took a huge dive in 2008. And it slowly began rebuilding. 2012, it continued to rise, but then we stumbled again in 2013. And in 2016, for the full year, J.P. Morgan reported ROE of 10%. That is down from 11% the previous year, and also missing the bank's own mid-teens target. Now, the fourth quarter was a boon, but the third quarter ROE for these banks was 8.4% on average, which was the lowest since June of 2015. The question really is now, with the economy slated to do better, Joe, and of course the Federal Reserve getting ready to raise interest rates, how that changes the trajectory of ROE for the banks.
Yeah, it's a great chart. It really just shows that banking just didn't ever really recapture what it was going into the financial crisis. And as you said, a lot of expectations that they'll surge back now. All right, let's talk about retail. Here are two lines. One line shows the percentage of all retail that's going to online or non-store retailers. The other one shows you the percentage of all retail sales that are going to department stores. I'm not going to tell you which one is which, but I'm going to tell you one just keeps going up at an incredible pace, and the other one just keeps going down. So one of these lines is department stores. One of them is online. One of them just hit a record high, the highest in history. One just is going to oblivion. I'm not going to say. I'll let you figure it out for yourself. But there's the chart, and I think it tells a pretty good story, even without identifying the two lines.
Yeah, this is not cyclical. This is structural.
I think this is. I don't see any mean reversion here.
No.
You're looking for that.
All right, the market close is next. Take a look at the major indexes with less than 4 minutes to go before the close. The Dow Industrials, a little change right now, off by 6 points, while the S&P 500 adds 4 points. The Nasdaq at yet another record high, 55.72 for the Nasdaq Composite Index. It's now gained, I believe, in 8 of the last 9 days. Pretty incredible run there.
Nice streak.
This is Bloomberg. We're moments away from the closing bell. What'd you miss? U.S. stocks rising towards a record and Treasury yields higher after solid economic data bolstered the case for higher interest rates. Financial shares also climbing today. We'll be hearing from CFO John Shrewsbury of Wells Fargo in just moments. I'm Scarlett Fu.
And I'm Joe Weisenthal. If you're tuning in live on Twitter, we want to welcome you to our closing bell coverage every weekday from 4 to 5 p.m. Eastern.
We begin with our market minutes. U.S. stocks advancing for the most part. The Dow edging somewhat lower at the end here, finishing little change. The banks, of course, in focus today because they kicked off the big earnings season. And not only did you have J.P. Morgan and Wells Fargo, but you also had Bank of America as well.
The early on in the earnings season, some decent ones. We're going to break them down. We're also going to be talking to the Wells Fargo CFO, but the start of earnings season kicking off at the banks.
And the NASDAQ, we should mention, at a record high, closing up 0.5%. It's the best performer of the three major indexes. And if you look at it over a 5-day period, a pretty strong week as well. In fact, it rose 8 of the last 9 trading days, and it closed at records 4 times this week. So a shout out there to the NASDAQ for the outperformance it's made. And of course, keep in mind that it had underperformed the Dow following the election of Donald Trump. Speaking of the banks, here are how the banks closed out the day. JP Morgan, Bank of America gaining less than 1%. Wells Fargo up 1.5%. More analysts had expected to see some negative effects from the fraudulent account scandal, but it was fairly muted from that perspective. The regional banks, Julie Hyman pointed this out earlier. This is the ETF that tracks them. They don't really begin reporting results until next week, but they are much more sensitive to the rising interest rate environment. And we see that group up by 1% in trading today.
Let's look at government bonds, starting with U.S. 2-year and 10-year, as we almost always do. Both of those ticking a bit higher. They were lower earlier in the day. If we look at an intraday chart of the U.S. 10-year, you can really see a lot of the action early this morning around 8:30 after we got economic data. The retail sales data, it didn't seem all that amazing. If you look at some of the core measures, missed economist expectations a little bit. Nothing particularly doing on PPI, but we saw rates shoot up afterwards and higher on the day.
Yeah, it was kind of a disappointing read overall from retail, but we had indications of that from the companies themselves in the days before. In terms of currencies, the dollar rounding off its 3rd weekly loss as measured by the Bloomberg Dollar Index. And in fact, this week, the dollar declined every day except for Tuesday, even on Wednesday when it had that big spike up and then it took a leg lower. UBS Wealth Management says it expects the dollar to peak in the next few months as other economies gather pace and they close the gap on the U.S. recovery. Let's just put the dollar's move, though, in perspective here. This is a 5-year chart, and it clearly shows the dollar holding near its highs. In fact, its record highs on the back of sizable gains in October and November. The election of Donald Trump, of course, seen as inflationary, but just reinforcing that strong dollar trend.
Absolutely. Let's finally look at commodities, starting with oil and gold. Very quiet on both fronts. Gold not doing that well lately, though, these days, down 1%. Gold basically unchanged. Where we did see some action was in the industrial metals, perhaps reacting to some good data out of China. If we look at lead, iron ore, zinc, all doing really well. Look at lead surging 5%. So these hard metals having a pretty good day.
Those are today's market minutes.
What'd you miss? The University of Michigan published preliminary consumer confidence data this morning, and we have the 3 charts you must see. For more, I want to bring in Matt Boesler, Bloomberg News economics reporter. Thanks for coming back, Matt. Story of the last several weeks, anything survey-based has just been taking off, whether it's company surveys, home builder surveys, consumer confidence surveys. They've all been shooting straight up. First chart we have here from the UMich survey that you've brought is people's opinions about their financial situation versus a year ago.
Yeah, so there's 2 components to the Michigan survey that I really like to look at. The first is how people are feeling about their financial situation based on, income. Are they making more money? The other one, which is the one we're looking at, is how are they feeling about their financial situation based on their debt and their assets. And so what we're seeing now is a lot of people are reporting that they're in a better financial situation than they were a year ago because they're able to pay down debt. And also the stock market is going up a lot. Right. And so it seems like there's a real wealth effect, kind of phenomenon occurring here. And that's what this chart shows, is the percentage of people who are saying, I'm better off than a year ago because of what's happening in the stock market and, with my personal debts. And so I find that really interesting that even though we haven't had a real, change in terms of the hard economic data, people are feeling better just because the markets have gone up since the election.
What I've noticed here, and Joe zoomed in on it, is the recovery since September. A lot of confusion before the election, people thinking that they wouldn't feel so great. But actually, it had been improving through in the lead up to the election and after the election.
Yeah, that's right. And you hear a lot of times people like to say things like, well, financial markets aren't the economy, this sort of thing. Right. But actually, I think this chart is a good illustration that maybe there's more to it than that, because in 2016 we had kind of a rough year for markets, right? And that was definitely reflected in the consumer confidence figures, as you can see here. And this chart really just looks like interest rates, too. You know, they fell a lot in 2016. Now they're back up to where they were. Same thing with consumer confidence. So it seems like there's a link.
Markets aren't just a snapshot, but also have a feedback mechanism.
Right.
Okay, so that's people's views on their financial situation. How about on unemployment or on the jobs market? Because when it comes to the U3 unemployment number, we're at 4.7%, near these lows. How much better can things get?
Yeah, so until recently, you know, we had seen that the unemployment rate had kind of flattened out over the past year. And so people were, you know, I think getting a little nervous. And the blue line here shows the percentage of people who think the unemployment rate will be higher a year from now. And you can see that this month it plunged to the lowest level since February 1984. So we're literally back to the Reagan days in terms of people's outlook for the labor market. They're feeling good. They don't think the unemployment rate is going to go up anymore. And you can really see that in this chart. You have to go all the way back several decades to find the point.
Right there.
Yeah, exactly.
Wow.
1984.
So we're seeing some amazing historical comparisons in some of these surveys right now, and I think this is a great example of that.
Could we see unemployment rate continue to drop significantly further? Like, could we see plausibly a 3 handle on the unemployment rate before this economic expansion is over?
You know, I think it's a really interesting question that we're all kind of wondering right now because, you know, for a while the narrative was that, you know, it's flattening out, it's not going to go down much. And of course, before that, it was, you know, dropping like a stone, and the real worry was that it would keep going. And so it kind of seems like we've gone back and forth a bit, and now the concern is shifting back toward, will the unemployment rate fall a lot more? And you certainly do hear some Fed officials talking about that.
Still seems like a good problem to have.
No, absolutely. It's a great problem to have.
And the final chart that you brought us is consumers' borrowing expectations are tied to treasuries. Walk us through this chart.
So this chart shows, the white line shows the percentage of respondents to the Michigan survey who think interest rates will be higher a year from now. And so at 75% this month, that was the highest or the largest percentage of respondents who see higher interest rates since July 2006. And the blue line shows the year-over-year change in the 10-year U.S. Treasury yield. And so you can see that consumers and markets track each other fairly closely. The interesting thing to note here, of course, is July 2006 marked the end of the last tightening cycle. So is it the case that consumers are kind of top-ticking interest rates here as well? I guess it remains to be seen.
It is pretty striking the degree to which these move in line.
Yeah, no, absolutely, and you know that just kind of like goes to show you. And there are a number of measures in the UMich survey, like going back 2 charts ago, right? There are a lot of measures where markets line up very closely with consumer sentiment and vice versa.
Even as consumers insist that they're not paying attention to every tick in the market.
Right, supposedly.
Somehow it all just filters in. All right, Bloomberg's Matt Boesler, thank you very much for joining us. And coming up, Wells Fargo is benefiting from higher interest rates and increased fee income from cards and deposit accounts. Wells Fargo CEO John Shrewsbury joins us from San Francisco. This is Bloomberg.
Elisa Parenti. Let's get to Bloomberg's First Word News. Congress has approved another step toward dismantling President Obama's health care law. Republicans have pushed a budget through Congress that provides an early but crucial victory. The budget prevents Democrats from using a Senate filibuster to derail a bill annulling and replacing the law. Now, that's critical because it takes 60 votes to end filibusters, while Republicans have a 52 to 48 Senate majority. The House has passed legislation that will allow retired General James Mattis to run the Pentagon. The legislation grants a one-time exception for Mattis from the law that bars former service members who have been out of uniform for less than 7 years from holding the top Pentagon job. The White House says President Obama will sign the legislation before he leaves office. The U.S. Supreme Court will decide whether employers can require workers to sign arbitration agreements that prevent them from pursuing group claims in court. The justices agreed to take up an issue that affects millions of workers who have signed forms waiving their rights to bring class action lawsuits over unpaid overtime and wage disputes. And Congressman John Lewis of Georgia says he will not attend the inauguration of President-elect Donald Trump. In an interview with NBC News, the 1960s civil rights legend says he'll skip the ceremony next week. Asked if Mr. Trump is a legitimate president, the congressman replied, no. Global News 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Elisa Parenti. This is Bloomberg. Joe?
What do you miss? Earlier this week, Sanford C. Bernstein put out a note on the divergence between stocks and bonds, saying it may be about to end. I talked with the author, analyst Inigo Fraser-Jenkins earlier today and asked him if it means diversified portfolios as we know them may not work so well in the future.
The last 35 years, it's been a particularly good environment for fixed asset allocation approaches. So, for example, approaches that do a 60-40 allocation between stocks and bonds. And that's been good because it's been an environment where both stocks and bonds have managed to rally, broadly speaking, but at the same time, the correlation between those asset classes has been very low. In fact, it's been negative in the last 15 years or so. And so our case is that if we look back over a much longer horizon, in fact, the experience last 35 years is very abnormal. So to give you an idea, the correlation of stocks and bonds over the last 250 years has been plus 0.3, and the last 15 years has been minus 0.3. And I guess if we look at forces at work on that and why that might be a change, firstly on the return side, of course, in the short term, stocks and bonds can track the progress of the economic cycle. But over longer horizons, and by this we mean horizons in the form of 5 to 10 years or so, it's very hard to escape the fact that stocks are more expensively valued than they normally are and bond yields are low. And from that starting position, our view would be that US stocks would be expected to return something of the order of 5% per annum, including dividends over the next 5 to 10 years, and bonds something in the order of 2%.
So the beauty of this portfolio that so many people essentially have, whether it's 50-50 or 60-40, is that both of the legs were going up. We both have been, in general, big bull markets, but on a short-term basis, they're not correlated, so you get the gains without volatility. So let's just say someone sticks with the 60-40 portfolio that so many people have. What's going to happen? Mediocre returns and amplified volatility because they're moving together?
Exactly. And so the last 35 years, we have both the returns have been high and the correlation between the asset classes have been negative. And we think both those things are going to change. Now, that's not a disaster, so we'd expect the return of stocks and bonds to be positive numbers. But at the same time, as the correlation goes up, the 60-40 combination of them that loses on both sides. And I guess the point we're trying to make here is that people have this mindset that a 60-40 passive allocation is in somehow a low-risk portfolio.
Right.
And our argument would be that for asset owners whose liabilities are set by the real economy and are probably more likely linked to CPI, then actually 60-40 can be a very risky portfolio, and risky in the specific sense of the risk of underperforming their liability being high.
So what is a better approach then? If you can no longer just set it and forget it, what will portfolio managers have to do to at least hit their benchmarks and meet their obligations?
Yeah, so I think there are a few things have to do. But I guess firstly, the asset owner community has to be very clear about what the ultimate benchmark is, because the ultimate benchmark probably is not 60-40. It's probably not set by capital markets. It probably is either a hard outcome or CPI linked. The other thing that can be done is people could start to look at kind of cross-asset class strategies. So rather than strictly dividing up the world by equities, bonds, and other asset classes, to start to look at strategies that cut across those. So, for example, one can start to explore the area of cross-asset risk premium investing, which has certainly started to gain assets the last 5 years or so.
Can you explain what that means specifically, as probably a novel concept to a lot of people? What does that mean, cross-asset risk premium investing?
So I guess one way of thinking about that is that we have some choices in terms of how we divide up all the assets which are available to invest in. I guess the most normal approach is divide up those assets by asset classes, but an equally alternative approach, but that would be to divide up assets by factors instead, and take the view that rather than saying that the primary things I can buy belong to equities, bonds or credit, instead you could say that the primary building blocks could be carry or mean reversion or momentum or income. And that can't be the whole answer. Yeah, but certainly that can certainly help in terms of alleviating some of the problems of 60-40.
So then what does a diversified portfolio look like in this new regime? What are the, sort of, how do you think about diversification if it's not just bonds, stocks, if we're not thinking about asset classes?
Yeah, I think it's very important for people to realise that the diversification that they've been used to from stocks and bonds is probably that's much harder to achieve. And so instead, one has to think about getting that diversification either from a collection of asset classes and these risk premium or factors, or also for the thinking about the allocation across things that currently are called alternatives, versus things that are not called alternatives, and perhaps loosening that strict loosening that strict dividing line and buying assets that span those two categories.
That was Sanford Bernstein Global Quantitative and European Equity Strategist Research Analyst Inigo Fraser-Jenkins.
Coming up, we're going to showcase your charts on the Bloomberg. We'll be looking at the numbers on Chinese imports. From New York, this is Bloomberg. Scarlet Fu, what you missed? Let's take a deep dive into the Bloomberg. You can find our charts using the function at the bottom of the screen. And Joe, you were talking to Inigo Fraser-Jenkins about stock-bond correlations. Right. Well, this chart is courtesy of Jim Paulson, who's at Wells Capital Management. If you're looking for an early warning sign for equities, he suggests watching the correlation to the 10-year yield, which is the top panel. It goes back to 1999, and there have been 3 times where the correlation turned negative, which means stocks and bonds started falling together. You had 1999, 2006, and 2014. They're all boxed in yellow. And in each instance, as you can see, it led to declines in the S&P 500, which is in the bottom panel. So it's been it's worked like clockwork in the last couple of years.
So something to keep an eye on in case that goes red. All right, I'm looking at a pair of charts about China. The first one was sent to me from George Perks of Bespoke Investment Group. It looked at year-over-year change in Chinese imports. That's the blue line versus the year-over-year change in the Bloomberg Commodity Spot Index.
Ooh, good.
Notice a similarity. Obviously, you do. Obviously, commodity prices have a big influence on total dollar volumes of imports. China, a big consumer of commodities. When commodity prices go up, those Chinese import numbers are going to go up. So important to keep an eye on the driver, although theoretically it could work in the other direction. And then finally, I want to look at one other chart sent to us from Mayank Seksaria of Macro Risk Solutions. The fuchsia line here is an inversion of the Chinese yuan strength, and basically what it shows is that as Chinese yuan weakens, then the Chinese economy picks up, and when the yuan strengthens, the Chinese economy slows. So that currency really does, the movement of that currency really does have an effect on economic conditions.
That's great. Great charts, Joe.
Thank you.
And thank you to Mayank Seksaria. Well, what you missed, Wells Fargo reported fourth quarter earnings this morning that show the bank is benefiting from rising interest rates and increased fee income from cards and deposit accounts. Still, the bank plans to close more than 400 branches over the next 2 years as it tries to trim costs. Joining us now from San Francisco is Chief Financial Officer John Shrewsbury. John, great to speak with you. Thank you for joining us today. I want to get straight to the impact from the fraudulent account problems because revenue held steady and we didn't see much of a fallout from those account openings. Analysts thought that we'd see more negative effects. Are we going to see it next quarter, next year? I wonder how far out we'll see the effects.
Sure. Well, so the effects that we're seeing right now are a slower rate of opening of different types of accounts, mostly because the people in our branches are adjusting to a new system for how to sell and how they're going to be measured and rewarded over time. We're implementing that new system right now. So for the fourth quarter, we expected things to be quiet, and it's those rates of growth that are down. But performance in the quarter, and as you mentioned, the use of our products and services by our customers is actually great. It grew very well in the fourth quarter. You mentioned card fees and account fees, et cetera. They're very strong. Deposits and loans, the building blocks of the business, very strong. We produced $5.3 billion worth of net income from all parts of Wells Fargo in the quarter. Well, one of the things that we saw a little bit of in the fourth quarter would be expenses directly attributable to professional services, people that we have helping us with the ongoing work that we're doing. We've brought in third parties to take a really hard look at a lot of our practices to make sure that there's nothing else that Tim Sloan, our new CEO, needs to know. And those are running on currently at about $40 or $50 million a quarter. I'll bet that ticks up a little bit throughout the course of 2017. So that is a direct impact. And then the accounts that aren't being opened today, a year from now or at some point in the future, would detract from rates of growth. So there's a possibility that future growth rates around some of those retail products are slower than they otherwise would be. But the core business with 20 million retail households, very strong.
So, John, what would be the turning point to indicate that fraudulent account scandal is fully behind you?
Yeah, well, it'll be a while. We're now having monthly calls for investors, and the financial press picks up on it, and we're showing the rates of growth and rates of change and all of the key drivers of the retail business. And I think it's the seasoning of this new approach to directing people and leading people in the retail bank in terms of how they're supposed to be dealing with our retail customers and satisfying their needs. That will show up in account openings, and I think that will be an indicator. Still a lot of work to do, but that'll be an indicator. And in the meantime, the accounting outcomes, the reported results, are actually still quite strong.
John, let's talk about about the macro environment. There's a lot of enthusiasm, animal spirits in the wake of this election. Interest rates are up. People expect the economy to accelerate. But interest rates potentially have a downside in terms of making home ownership more costly, making it more costly to get out loans. That appeared to show up in your earnings as well as Bank of America's earnings. To walk us through a little bit more the effect that higher rates is having on lending.
Sure. So mortgage lending, mortgage banking, the way we execute it, and I assume other large banks as well, has the component of it where people are borrowing money. We're packaging those loans, and they become part of agency securities, Fannie and Freddie. And then there's a part of mortgage lending where loans sit on our books, and they impact the revenue streams of banks differently depending on what's being sold or what's being retained. As rates move up, the incentive to refinance on a per borrower basis starts to go away because people's current mortgage coupon outstanding is attractive versus the higher market alternative, and so you should expect to see fewer refinancings happening, and certainly that's present now in the application data because rates moved up, call it 100 basis points in the fourth quarter. While mortgage rates are still really attractive by long-term standards or medium-term standards, and home prices are still affordable as a result of that. So if the economy gets stronger and jobs are stronger, and as long as supply is available, my sense is that the purchase market should be very strong over this cycle if we do in fact get economic growth. I don't think from a mortgage lender's perspective, I don't think it's going to make up for the refinancings that aren't there because people already have an attractive coupon and they're going to stay in their home and keep their loan for a long time. So that's why we're happy. We have a very diversified business model. Mortgage banking is about 15% of our non-interest income activity where we package loans and sell them and service loans. And it's a great business. We're happy to have it. But that refi component of it is really only there in periods of rallying rates. And we've been through a long one, but that's quieter now.
All right, understood. We also mentioned that you're closing 400 branches in the next 2 years. How are we to interpret this move? I wonder where and in what capacity and what this says about your strategy.
Sure. So we have about more than 6,000 branches today in the U.S. We're the largest. We have the largest branch footprint in the U.S. We have new leadership in our community banking business, Mary Mack, who's been on the road, and I'm sure your colleagues have been speaking with her. And she's taking a fresh look at what our customers are looking for from us, how much business they want to do via mobile, how much they want to do online, how much they want to do in person, and what the requirements are to meet those needs. So with that lens, we're looking at all of our businesses, including hers, and asking ourselves, how many physical points of distribution do we need today? And we'll continually feed back, what trends are with customers, how they want to be treated, how they want to do business, and we'll apply that to the branch footprint that we have outstanding. This move of call it 200 this year and maybe a little bit more next year is a pretty modest move compared to some of the branch reductions that some of our peers have embarked on. We're a last mover here because our branches have been very busy and serving customers, and they still are, even in light of what we talked about earlier. There's still a lot of service and a lot of foot traffic. But it's a modernization. It reflects customer preference, and we're not moving away from the physical distribution approach. It's still a critical part of the overall solution, but how it fits, how much of it to have, is something that's definitely evolving as people are doing more specifically on their phone.
All right, John Shrewsbury, thank you so much for joining us. Wells Fargo's Chief Financial Officer joining us from San Francisco. Let's get you to First Word News now with Elisa Parenti. Elisa?
Thank you, Scarlett. The White House has released the schedule for President Obama's last week in office. Mr. Obama will hold his final presidential news conference Wednesday. The president and the First Lady will also host the Trumps for tea Friday morning before the Capitol Hill ceremony. After the inauguration, the Obamas will depart D.C. on a presidential aircraft to a destination yet to be announced. President-elect Trump is considering former biotech executive Balaji Srinivasan to lead the FDA. That is according to people familiar with the matter. The development puts into the running another candidate who's aligned with venture capitalist Peter Thiel. Srinivasan has reportedly pulled ahead of another Thiel associate, Jim O'Neill, to lead the FDA. U.S. Ambassador Samantha Power is urging the Trump administration not to cut funding to the United Nations. She's warning it would be, quote, extremely detrimental to U.S. interests and would only benefit countries like China and Russia. In her final news conference today, Power said, quote, we lead the world in part by leading at the United Nations. And inaugural planners have released the lineup for President-elect Trump's welcome celebration on the eve of his swearing-in. Headliners include country star Toby Keith, singer Jennifer Holliday, and actor Jon Voight. Trump's team says other performers include the rock band Three Doors Down, the Piano Guys, and country singer Lee Greenwood. They'll perform a free concert at the Lincoln Memorial. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Elisa Parenti. This is Bloomberg. Scarlett?
Thank you so much, Elisa. Let's get a recap of today's market action. The Nasdaq notching another record high, up 0.5% to 55.74. The Dow, little change at the close, off by 5 points, but certainly not getting us towards that 20,000. In fact, Tom DeMark, the chart watcher, had indicated that he didn't see it happening in this cycle.
Yeah, no, still impressive streak there on the Nasdaq continues to power to new record highs, but the Dow is really stalling out, really not moving anywhere in a while.
And of course, the big banks reporting didn't actually give the Dow the push that many may have thought it would have. What'd you miss? Considering all the attention Donald Trump gets from his tweets, how can the struggling company, Twitter, monetize off of the president-elect? So here's some notable tweets that shook the business world over the past couple of months. On Carrier, Trump tweeted, "Big day on Thursday for Indiana and the great workers of that wonderful state. We will keep our companies and jobs in the U.S. Thanks, Carrier." On Ford, he said, "Thank you to Ford for scrapping a new plant in Mexico and creating 700 new jobs in the U.S. This is just the beginning. Much more to follow."
And on Boeing, he tweeted, quote, "Boeing is building a brand new 747 Air Force One for future presidents, but costs are out of control, more than $4 billion. Cancel order." Joining us now for more is Howard Lindzen, co-founder and chairman of StockTwits and general partner at Social Leverage. Howard, your Twitter, markets, the president, this is like right in your sweet spot because you've been all about how Twitter should be this tool for the markets. Now, from time to time, Trump moves stocks with his tweets. So the only entity that's really not benefiting here is Twitter. What should they be doing? What would you do if you were the CEO right now?
Great question. I don't think it matters what I would do. Obviously, I think they should take big risks. I mean, if I own the stock right now, I talked about it last week, I finally bought some back because my daughter tweets, and she's in college. So they have a harassment problem, big problem. The harassment starts right now at the top. Trump's lived on borrowed time on the platform. It's a privilege, not a right. He has abused the privilege. He is not special. He is the president now, but he broke the rules years ago and is lucky to be on the platform. So that's the main problem with Twitter, is that you have to clean the place up. It's a bar, not a social network. Twitter is a...
You'll probably get abusive tweets right now just for suggesting...
I quit for a month, not because I was getting abused, just because to see what Twitter was like without contributing. Right. And so in that sense, Twitter is an idea platform, right? An idea generation. So I always thought they were very big disruptor potential to Bloomberg. Bloomberg now obviously buys the data, but so I always felt Twitter was a social Bloomberg. And it still is that. There's a lot of noise, but to the financial industry, that actually is signal. The noise is a signal. The more you trade, and we run StockTwits, I started StockTwits, the more you realize watching it all day is fun. Trading all day is stupid. But the idea, the zen of investing is watching without doing, right? Picking great ideas a few times a year. Right now we have very low volatility, even though we have the highest volatility president of all time, or president incumbent. Something crazy is going to happen. I can't predict when. And Twitter should kick him off. Those are the type of moves Twitter needs to make. They need to make bold moves. They need to get into the transaction business, and they need to get rid of spam, and that starts right at the top.
I wonder to what extent...
It hasn't helped the stock. Sorry, it hasn't helped the stock. Guy has not helped the stock. No. The stock will rise 20%, kicking him up. He will mess with Twitter during his presidency. He himself, through Verizon and AT&T and the FCC, is going to cause Twitter so many problems as a company over the next 4 years.
Such as, specifically?
Meaning he is in control of Twitter. Meaning you can't, if you don't get rid of these people, at some point they take over the product. And so he is running the product, not Twitter.
It's interesting you say that, and I wonder to what extent investors just simplify to, you know what, Trump is tweeting bad things about certain companies, I'm going to sell those companies. And Trump is tweeting good things about other companies, so I'm going to buy those. And Barry Ritholtz, who's a Bloomberg contributor, actually created
Barry's
these
overrated,
custom indexes.
like Trump.
Custom indexes. And if you come inside the Bloomberg here, the white line is what he calls the oligarchy index.
Yes,
and it
cool.
includes companies that Trump has praised. As for
but Trump will praise these same companies he hated last week. So the index is funny, but makes no sense.
And then the blue line indicates the swamp index, companies that Trump has called out on in a negative way.
Yes.
And you can see the performance. There's a huge gap in the performance. The oligarchy index is up almost 17% since the election, whereas the swamp index is up only 4.5%.
This is the genius of Twitter. This is what they should have been doing from day one. Meaning, I knew Trump would tweet. I didn't know he'd be president, and it would matter. I assumed Carl Icahn, Warren Buffett, other traders would use Twitter. They are.
They
it's
do.
just I was 8 years early. So now we're seeing it's like the show Black Mirror on Netflix. If they did a show about the financial markets, I probably would have written it. No one still would have seen it, but it would have been a really good show. The world is changing. We are connected, right? And the most important business, as we see with Bloomberg, and the fact that Mike's coming back to run the company, is this is the greatest business in the world. It's magical, there's data, there's everything going on, and they are now just kind of a comedy show to what they could have been. And Trump wrecks their brand, doesn't help the brand, he wrecks the brand.
Out of curiosity, I mean, StockTwits, it's this platform that was originally built on Twitter.
Yes.
Twitter is not the only place that's blowing off social data all the time. Signal or noise that could be turned into Signal. Is anyone doing anything, like, say, with Facebook, or is that a harder nut to crack in terms of extracting signal from that to trade on?
I don't know who Facebook's selling their data to. Probably nobody, right? There's many companies funded. StockTwits has its own unique signal, meaning StockTwits is an optimistic crew. It's like Cheers. Like it's taken on, obviously, a much bigger personality than me, but we have been optimistic. We were started in 2008 on top of Twitter. We moved in 2009 to being our own platform. Today, there's 130+ thousand messages a day, over 200 a minute, focused on just stocks, because we invented the dollar sign, on StockTwits, not happening on Twitter. So that's where Twitter missed the boat. They could have owned all of that. Now they're just a fragment of that. Just like, so StockTwits, if you ask PR Newswire, our data's 10 times better for financial stocks. So again, it's all fragmented now. And Bloomberg's in a great position, or people that can consume all that data really have the power. So another thing Twitter should do is not sell their data. Right?
Just keep it to themselves.
Why not? And build the world's largest hedge fund. That's what Google did. That's what they're doing. That's why I own Google.
Yeah, what is your view? You own Google.
Yeah.
What is your view? What's the bull case?
And I do own
Google
Twitter,
right
as I mentioned.
Yes.
What's that?
What's the bull case for Google right here?
The bull case is just they are the perfect machine for this era. They're both they take all this cash, this margin that they make in running their core business, which isn't going away, obviously, and even if it declined a little bit each year, it wouldn't matter, and invest it using their data in everything that's coming up and rising. They know more than everybody. They are a perfect hedge fund. And they run it and they feed people. Basically, Google's job is to hire, feed them, and yes, they leave, but the more they leave, the more they wish they were back at Google. The smartest people work there. That's their job, feed the brain, and then reinvest the money. So I think it's a perfect hedge fund. I think, you know, when people talk about the NASDAQ at all-time highs, well, Google's at all-time highs, right? And I think if you can take the volatility, Google's the only ETF in technology that people need to own and simplify their lives, right? Because they're taking that media business and applying it into technology.
Is there any other company that's like Google that could be another perfect hedge fund or technology ETF?
Well, I think Amazon, just because of the leadership, right? Google's run by the founders. Amazon's run by the founders. Everybody thinks Amazon's expensive. Same with Netflix. But we are entering this content boom in the sense that we are busy people. You know, I define busy as like we're not at war and blah, 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 and we love our jobs, but we find stuff to do. We completely are underestimating how much content we're willing to consume if it's good. We sit, we lean, we chill, we binge, and we're supposed to be busy, right? And I think we are entering this era where these channels like Netflix and Amazon are so going to rule our time.
Real quickly, so Facebook, that stock is on a surge again lately, but it's a center of a lot of controversy these days. There's worries about disinformation that's on Facebook, privacy. A lot of media companies have put all their content on Facebook and not really seen much return. Do you think Facebook is going to run into trouble just because of how powerful an entity from sort of a political standpoint it is, that policymakers around the world are going to start to see it as something that needs to be regulated?
No, I mean, they're unstoppable. I don't own it because I'm not a Facebook user. I love Instagram and I love WhatsApp when I need it. But I watch my wife and I watch, you said the kids say they hate it, but my kids use it for a certain utility. Right. And I watch my wife get her news from it. She's not dumb. I mean, it's up to the user, right? You can only give people what they give. Tobacco should have killed everybody. It didn't. We have to learn how to live with these tools.
Right. All right.
Howard Lindzen, co-founder and chairman of StockTwits and general partner at Social Leverage. Thank you very much.
Coming up, with the S&P 500 hovering around a record, is there trouble ahead for sentiment? How far is too far? That's next. This is Bloomberg.
For the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. The U.S. Justice Department said Takata will plead guilty and pay a $1 billion fine to settle an investigation into its exploding airbags. They've been linked to at least 17 deaths worldwide. The company will admit to wire fraud for misleading regulators about the safety of those airbags and also be subject to an independent compliance monitor while on probation for 3 years. U.S. prosecutors also filed federal charges against 3 Takata executives for their alleged role in a scheme that ran for 15 years. Canada Goose is planning to go public as early as next month. That's according to people with knowledge of the matter. It's an initial public offering that could value the company at about $2 billion. The Toronto-based retailer is backed by Bain Capital and known for its trademark $900 parkas with coyote fur-lined hoods. It is aiming to go public in February or March. Wet Seal is considering a sale or bankruptcy after struggling to turn around the business. That's according to folks with knowledge of the situation. The mall retailer is owned by Versa Capital Management and could make a decision as soon as next week. If Wet Seal decides on bankruptcy, it would be the second in 2 years. And that is your Business Flash update.
What do you miss? Euphoria or respite in this hated bull market? There's little doubt that optimism over Donald Trump's policy plans has spurred animal spirits, largely absent during the stock rally that began in 2009. With the S&P 500 index hovering around a record, what's debatable is whether the sentiment has gone so far that it spells trouble. Bloomberg stocks reporter Oliver Rennick explains.
All right, let's check this out, because basically what we're trying to figure out, Joe, is indeed whether or not the sort of movement we've seen since the election is something meaningful and whether or not it's gone too far, too fast. Let's check out one thing here that we have chronicled so well the past year, and that's been short interest, SFUSTOTL on the Bloomberg. This is a good way to get short interest across basically all U.S. traded stocks. Look at the 5-year look here if we take it back towards 2012. What we saw is a move up throughout 2015, and we wrote about this over and over and over again. The short interest was getting higher and higher and higher, close to the highest since 2008 and almost close to on record. What's been interesting is since the election, that's all come down there. If you look at this green line here, we're now basically the lowest. We're at 3.6% average of the float across all stocks, which is the lowest since 2013. We went from basically being the highest in 5 years to now the lowest. We've seen a lot of people get out of those short positions. That's very interesting. That's obviously a pretty bullish sign. Let's switch it over here and let's look at whether or not people are actually putting their money where their mouth is. This is looking at sentiment readings, AA, not the best, but it's a decent gauge. It's really high. It's at the highest since about 2014, so people are feeling good about the market. End of the day, though, we look at flows on SPY down here. We had a couple big bumps, November and December. January, they're taking money back out. So we're not really sure if people are going to put that money to work quite yet. Then finally, let's look at what this means for the VIX. This is a great chart that comes from Peter Cecchini at Cantor Fitzgerald. I love it. Hard news on a Friday for the end of the week. If you're not using the HRA function on Bloomberg, you're not looking at correlations right. This is the way you do it. I'm looking at the VIX versus the volatility of the VIX, the VVIX. This basically plots a historical regression analysis where you can see where you currently are for these two variables. VVIX down here, VIX up here. This red star is where we are right now. The fact that it's so far away from where the relationship is indicated in the past indicates that one of these is doing something irregular. Either you're in part of a regime shift now where VVIX is going to stay high relative to VIX, or one of these has got to come down. Either the VVIX needs to get back to a normal level down here, i.e. volatility of vol comes down, or vol for the VIX moves up. So something there is a little bit out of place, and that means a lot for the market right now.
So, Oliver, it's really clear that we are at some kind of inflection point, but investors at the same time are not ready to take that next step.
Right.
You mentioned the flows are not there to back it up. Bears are finally capitulating, but it doesn't mean they're necessarily going long either.
Right. So here's the thing, is that you got to figure out whether or not the sentiment actually translates in anything meaningful. We always talk about euphoria. We talk about whether or not we're in bubble stage. But at the end of the day, it only really matters if people are putting money to work. As we saw from flows there, we did have some decent flows in the SPY in November and December. And we saw that in some of the other active managers as well, where people are getting a little bit more comfortable putting their money to work. But we're still very far away from the euphoria. We're still very far away from everybody putting all their money and all their chips on the table.
So just from like a pure positioning flows data, if that was the only thing you were looking at, you would not conclude that this is what euphoria looks like.
Absolutely not. I think what you would conclude is that this is sort of a, not a reversion, if you will, because there's no average where flows have to be, right? But this is more sort of people reassessing and saying they're now a little bit more bullish than they were. I think the sentiment readings are there. Maybe those flows will continue to come in, and then it gets even more complicated with the VIX stuff.
And anecdotally, no one's calling it the most hated bull market anymore.
Right. It's not.
There's a lot more conviction in, ooh, maybe this can continue.
Totally. It's now, it went from being the most hated bull market to being the most loved, like 1 month to 2 month long move in stocks.
So the soft indicators have really reversed a lot. Thanks, Oliver Rennick, Bloomberg stocks reporter, for the look at sentiment in this rally. Up next, China has set regulations to try to ease the fear of a real estate bubble. But is it working? We'll take a look next. This is Bloomberg. What do you miss? One of the biggest issues in China right now is the overheated property market. But the country is working to rein in the problem. I spoke to Peking University professor Christopher Balding yesterday to get his thoughts on whether the danger has passed.
Well, basically, Beijing has delegated a lot of the property cooling measures to local governments. And so they've allowed local governments like Shanghai, Shenzhen, and the second-tier cities to implement various cooling measures, like married couples that get a divorce still cannot buy a property for 6 months or something like that. So they're trying to delegate that authority, but it's going to be questionable how successful that's going to be when it's not national, when there's no unifying policy about this.
Something that you pointed out, I saw it in a tweet of yours, is that the government really isn't interested in cooling the property market too much, ultimately. Explain why that is.
Yeah, well, one of the issues that is so fundamental to this is that local governments throughout China receive large amounts of their revenue from various real estate activities, whether it's land sales, whether it's taxes from real estate development firms, whatnot. And so by some estimates in recent years, local governments have gotten 50% of their revenue from real estate related activities. Even in 2015, Citi just had a note out recently that found about 45% of local government revenue was from real estate. And so basically, if they kill the golden goose that is keeping all their local governments afloat, that's going to be a lot of revenue for them to make up in taxes that they're going to have to directly impose on households that are already feeling the strain from an economic slowdown.
Kind of sounds like a situation you might see anywhere else with that, including even in the U.S., nobody really likes bubbles, but in the end there are a lot of taxing authorities that depend on asset prices always going up.
That's exactly it, and we see Beijing behaving very much as you've described. In the past year, new mortgage lending is probably going to be up almost 100%, and even the total stock of mortgages is going to be up more than 30% for 2016. So at the same time Beijing talks about wanting to contain this asset bubble, they also have to feed it, because part of it is also household expectations about how much real estate is going to go up. Because by some estimates, Chinese households have 80% of their wealth in real estate.
That's interesting. You don't really hear that much, as China wants to turn towards a more consumer-driven economy. How expand on that a little more, the degree to which spending and consumption is dependent on that real estate wealth continuing to expand.
Well, basically what we're seeing here is the wealth effect, and so people are trying to be able to tap that wealth that they have from their homes. Right. In Shenzhen, the city where I live, our real estate prices are generally higher by any metric that you want to use than even Midtown Manhattan. There's a real estate building, there's a new building near me. I just learned the other day the average price that they're paying is about $3,500 US a square foot for this building. And if you look at the household budgets, they are significantly strained. But one of the things is people are coming up with new and interesting ways to be able to tap the wealth that they have to drive consumption.
Nothing makes me nervous, or nothing should make you nervous, than talk about new and interesting ways to tap household wealth for more consumption. What are some of the ways that people are trying to monetize this real estate wealth?
I just heard about something the other day of a couple of American financial institutions basically offering essentially loans securitized with collateral of Chinese apartments. To me, that seems an incredibly risky aspect. It's also interesting to note that that this actually acts as a type of capital outflow, so that people can borrow abroad against their home in China, and it gives them money outside of China already. So it's also helping evade capital controls.
That was Bloomberg View columnist and Peking University professor Christopher Balding. Coming up, what you need to know to gear up for next week. This is Bloomberg.
What you missed, the NASDAQ climbing to a record high. The Dow little change on the day. Disappointing retail sales kind of set the tone. And, of course, banks reported earnings. In terms of what to look for next week, don't miss this. On Monday, the World Economic Forum begins in Davos, Switzerland. Later that week, we will be hearing from Jamie Dimon, Lloyd Blankfein, James Gorman, and Brian Moynihan, all the big banks CEOs. You don't want to miss that. All coming up.
So many interviews from Davos. Then on Wednesday, Obama will host the final news conference of his presidency. Also next week, we'll have confirmation hearings for Wilbur Ross and Steve Mnuchin.
And don't miss this, Inauguration Day. Donald Trump will be sworn in as president on Friday. That is at 12 noon, I believe, right?
Exactly noon.
12 noon. All right. That does it for What You Missed. Thanks for watching.
Have a great evening and weekend. This is Bloomberg.
I'm Elisa Parenti, and you're watching Bloomberg Technology. Let's start with a check of your Bloomberg First Word News. Congress has approved another step toward dismantling President Obama's health care law. Republicans have pushed a budget through Congress that provides an early but crucial victory. The budget prevents Democrats from using a Senate filibuster to derail a bill annulling and replacing the law. That's critical because it takes 60 votes to end filibusters, while Republicans have a 52-48 Senate majority. The House has passed legislation that will allow retired General James Mattis to join the Pentagon and run it for Donald Trump. The legislation grants a one-time exception for Mattis from the law that bars former service members who have been out of uniform for less than 7 years from holding the top Pentagon job. The White House says President Obama will sign the legislation before he leaves office. And the U.S. Justice Department says Takata will plead guilty and pay $1 billion to settle an investigation into its exploding airbags. They have been linked to at least 17 deaths worldwide. The company will admit to wire fraud for misleading regulators about the safety of its airbags and be subject to an independent compliance monitor while on probation for 3 years. Prosecutors also filed federal charges against 3 Takata executives for their alleged role in a scheme that ran for 15 years. Global News, 24 hours